The Dutch once traded tulip bulbs for the price of mansions. 400 years later, we have Bitcoin, same psychology, different technology. Here's what never changes. The cryptocurrency market is currently traversing a tumultuous sea, where price fluctuations are no longer mere numbers on a screen, but the profound consequence of macro and micro-level forces. From wavering investor confidence to crumbling infrastructure, the ground beneath us feels like it's shifting, and the unnerving truth is, no one truly knows where the bottom lies, or if there even is one. So, what's truly happening in the world of crypto? Is this a bottomless pit we're falling into, or are there still glimmers of opportunity for the discerning investor? In this video, we'll demystify the recent price swings, delve into the core issues plaguing the market, and explore the potential paths forward. Welcome to 7 Days Upgrade, and this is where we simplify finance, economics, and investing, making it so clear a 5-year-old could grasp it, and an 80-year-old could confidently invest their hard-earned money. Most importantly, we offer an authentic perspective on the investment journey of someone starting with zero economic knowledge. Please note that the insights shared here are a synthesis of information from various sources and personal experience. The chilling grip of macroeconomics. As someone who monitors the market daily, I can keenly feel the current chill. It's far more than a minor correction some still try to convince themselves of. One of the most significant drivers of recent crypto volatility is macroeconomic monetary policy. This is something the crypto world used to FUD or dismiss, believing it was immune to traditional financial systems. The reality? Not so much. The U.S. Federal Reserve hasn't eased interest rates as many had hoped. Instead, they've maintained a hawkish stance, committed to keeping rates high to curb persistent inflation. This has created immense pressure on risk assets, and crypto, without a doubt, falls squarely into that category. When interest rates rise, investors reevaluate risk. They become less enthusiastic about volatile assets like Bitcoin and altcoins, opting instead for safer havens. Think U.S. Treasury bonds, offering a stable 4 to 5% annual return with virtually no capital risk, or the timeless Asian preference for gold, a historical bulwark against instability, which has consistently hit new highs in the past year or two. For large investment funds, it's a no-brainer. Why gamble on crypto when you can secure guaranteed returns with minimal risk? Profit isn't enough, capital preservation is paramount. Political winds and trust erosion. Beyond monetary policy, shifts within the U.S. government are adding to market turbulence. The change in leadership at the SEC initially sparked hope for a more crypto-friendly regulatory environment, a breath of fresh air after the restrictive era of Gary Gensler. However, things are rarely that simple. A more open door also, perhaps inadvertently, created opportunities for scams and pump-and-dump schemes that prey on greed and collective blindness. A stark example is the meme coin launched by Donald Trump and his wife, heavily promoted by the MAGA community. This token skyrocketed, only to crash by 90%, leaving many investors, especially newcomers, financially devastated and, more importantly, trust shattered. It's truly disheartening to read posts from holders saying things like, "I invested because I thought it was the president's coin," only to find it was a scam. If the US president can rug pull the world, what about other coins? Geopolitical ripples and diminishing safe havens. Adding to the instability, geopolitical tensions are exacerbating an already fragile market. The U.S. imposing new tariffs on Chinese imports has not only rattled stock markets but has also had a domino effect on crypto. Bitcoin was once seen as digital gold, a refuge during economic uncertainty. However, that belief is clearly eroding. The strained U.S.-China relationship, with increased scrutiny on tech companies and cautious international capital flows, disproportionately impacts crypto, a borderless asset class. The market feels squeezed between tightening Western policies and Asian skepticism, with nowhere to hide. A defensive mindset is now prevalent. Internal wounds, security breaches and infrastructure glitches. Beyond macro issues, a significant contributor to the market's stalled recovery has been a barrage of internal security breaches within the industry. The recent Bitfinex hack, resulting in a staggering $1 billion loss, reportedly to North Korean entities, sent shockwaves through the community. Bitfinex was widely considered one of the most reliable and wealthy exchanges. This incident has even caused loyal users to question the security of centralized exchanges. If a platform of that caliber can be compromised, where is anyone truly safe? Even the DeFi space isn't immune. While a $5 million loss on ZKSWNC might not seem enormous in the grand scheme of total value locked in DeFi, the sophistication of these attacks is terrifying. It's not just about lost funds, it's the erosion of trust in smart contracts and the risk management capabilities of development teams. Many investors are now opting to convert assets into stable coins and store them in cold wallets, choosing to sit on the sidelines rather than actively trade. Furthermore, operational infrastructure is proving to be another weak link. Recent AWS outages impacted Tether, USDT, the world's largest stablecoin, along with major exchanges like Binance and KuCoin. The inability to deposit or withdraw funds during these disruptions created panic and frustration, further eroding investor confidence. The investor psyche, apathy and exhaustion. Perhaps the most critical factor is the investor psychology. Those who invested in coins launched since 2023, like SNet, Alt, and Pixel, understand this well. These tokens have seen their values plummet by 5x or even 10x from their peaks, often being overvalued at launch, with teams and venture capital funds consistently dumping on retail investors. Layer 2 solutions like StarkNet, ZKSWNC, and Scroll have also experienced significant declines with no signs of recovery. This puts immense pressure on Ethereum, as these Layer 2s are built on its network. Stablecoin inflows into the ecosystem have stalled, and DX trading volumes have plummeted. On-chain metrics paint a clear picture of investor apathy, a diminished appetite for risk. It's not just tokens, NFTs, once boasting million-dollar valuations, are now worth less than 10,000. The market's overall sentiment is overwhelmingly negative. This apathy is truly frightening. A market can survive fear, but it cannot survive when trust is depleted. I've witnessed numerous market crashes, but this one feels different. There are fewer fervent debates in online forums, fewer irrational, by the dip impulses because so many have already been burned. Instead, there's a prolonged silence, a distinct coldness that only those who have endured a crypto winter truly understand. In summary, the market is being pulled down by a confluence of factors: tight macroeconomic policies, geopolitical instability, internal industry problems, and, above all, a deeply fragile investor psyche. My personal view is that this is not the time to chase highs or go all in. This is a period for observation, for portfolio restructuring, and for highly selective investment. Crypto won't die, but it's entering a severe cleansing cycle. For those who still believe, patience is key. For those still dreaming, it's time to wake up before it's too late. Let's look at the current price landscape for top cryptocurrencies. In early May 2025, Bitcoin experienced a slight 1.5% dip, falling to the $83,700 range after a speech by Fed Chair Jerome Powell. This once again underscores the profound influence of traditional financial policies on the crypto market, a connection many previously dismissed. I wasn't surprised by the market's reaction. Any hint from Powell that interest rates will remain high instantly sends ripples of caution. In today's highly sensitive market, a single hawkish remark from the Fed can wipe billions from market capitalization in hours. Ethereum finds itself in a strange limbo. Its price has shown little significant breakthrough in the past 3 years, especially after the merge and subsequent upgrades. Hopes for ETH to become the undisputed smart contract platform have been eroded by the harsh reality of strong competition from Solana and Layer 2s like Arbitrum, Base, and ZKSWNC. It's like a king trying to hold on to his throne while his subjects whisper about potential successors. Meanwhile, altcoins are under immense pressure. Solana, a beacon of hope during the early 2024 recovery, has now reversed sharply, dropping from nearly $200 to around $130 to $140, seemingly unable to find a stable equilibrium. XRP, as usual, continues to disappoint with its characteristic sluggishness. For a moment, the resolution of its SEC lawsuit seemed like a potential catalyst for an upward trend, but it turned out to be a fleeting illusion. The overall crypto market is in a correction phase, with an average decline of about 4.4% across its total market capitalization. These days, you'll notice an increase in stablecoin reserves on exchanges, while trading volumes dwindle. People aren't exiting the market entirely, but they're not eager to buy coins either. A look back, Bitcoin's all-time high and shifting dynamics. It's important to reflect on a recent significant milestone, Bitcoin hitting its all-time high of $100,000 in Q4 2024. That was a special moment. I vividly recall the electrifying atmosphere on Twitter and Telegram communities. Everyone believed $100,000 was just a temporary stop before Bitcoin soared higher. However, reality proved otherwise, leading to the prolonged correction we're experiencing now. An interesting development is that altcoins are no longer strictly following Bitcoin's lead. Previously, a Bitcoin surge often triggered an alt season. But now, capital flowing into altcoins isn't primarily denominated in Bitcoin. Instead, it's flowing from stablecoins like USDT and USDC, and fiat trading pairs like USD and Euro. This indicates a more mature market structure, but it also means Bitcoin is no longer the reliable lead horse for other coins. If you ask me to predict whether Bitcoin will go up or down, or where it will settle, I genuinely wouldn't know. Just a few days ago, it was around $80 to $85,000, and now it's at $111,000. It's incredibly difficult to act in this environment, only the truly daring and lucky stand to profit. As for altcoins, I believe they'll continue to struggle if Bitcoin dominance, Bitcoin's market cap percentage of the total crypto market, continues to rise. Increased dominance typically means capital is seeking refuge in Bitcoin rather than risking it on smaller altcoins, a common trend during periods of uncertainty. Crucially, short-term recovery is not dependent on technical analysis or on-chain metrics. Everything hinges on macroeconomic news. A positive development, such as the SEC approving more spot Ethereum ETFs or the U.S. Congress passing pro-crypto legislation, could ignite a new wave of investment. Conversely, a single negative tweet from an influential figure is enough to send the entire market spiraling. Beyond the FUD, seeds of long-term growth. Okay, enough of the doom and gloom. Let's talk about the positives. There are times when the market feels overwhelmingly heavy: falling prices, relentless bad news, community division, and shaken confidence. But when I step back and examine the foundational elements slowly taking shape, I see a different story. It's more positive, deeper, and far more long-term. Crypto isn't just about daily price fluctuations. It's a technological revolution, a financial paradigm shift, and a reassertion of asset control. The subtle changes unfolding behind the market's curtain are truly what's worth noting. You might hear less about crypto politics in mainstream media these days, but for close observers, policy moves in the U.S. are bringing a fresh wave of optimism. Donald Trump, despite his controversies, has publicly stated what the crypto community has long desired, making the U.S. the global crypto capital. This isn't just campaign rhetoric, it's a signal that blockchain is no longer a fringe player, pushed to the side by traditional finance. It's slowly moving to the center stage. Alongside this, legislation like the Gensler Bill, a proposed regulatory framework, and supportive actions from the Office of the Comptroller of the Currency, OCC, allowing traditional banks to custody crypto, represent monumental strides. I remember just 2 or 3 years ago, a major bank publicly holding Bitcoin for clients was unthinkable. Now, it's a strategy to expand financial services and re-engage younger generations who are losing faith in outdated banking systems. These policies are blurring the lines between traditional finance and crypto, creating a massive opportunity for crypto to shed its risky image and embrace a new role as a legitimate asset class in both individual and institutional portfolios. Stablecoins, the unsung backbone of digital finance. Another crucial piece of the long-term puzzle is stablecoins. You might primarily know them as USDT, the most popular stablecoin in the market. But behind that name lies a bold expansion strategy. Recently, Tether invested in Pian, a multi-chain wallet platform designed to facilitate global payments and consumption using stablecoins. This not only strengthens Tether's position but also enhances the stability of the DeFi ecosystem, which desperately needs robust financial layers to attract new capital. As stablecoins become more accessible and transparent, the entire market will become more comprehensible to the average user, a prerequisite for crypto to truly integrate into everyday life. However, an undeniable truth is that stablecoins currently account for 63% of all illicit transactions, according to recent statistics. While this is a dark side, it also highlights something interesting. Stablecoins possess extremely high liquidity and are widely used, even in underground markets. From a technological development perspective, a tool only sees such widespread adoption when it's effective and convenient. If we can combine this powerful utility with a tighter regulatory framework, stablecoins could absolutely become the backbone of online digital finance. Furthermore, the real-world applications of blockchain are becoming increasingly tangible, far beyond the vague demos of a few years ago. One advance I highly commend is blockchain's use in cross-border remittances. International money transfers used to be slow and expensive, but now, with protocols like RippleNet and Stellar, you can send thousands of dollars across borders in seconds, with near-zero fees. I once tested a transaction from Vietnam to the US using USDC. It processed in less than a minute and cost less than sending money domestically. If you've ever been an international freelancer or have relatives abroad, you'll understand the value of this convenience. Beyond currency, blockchain is opening entirely new avenues for traditional investments through asset tokenization. Imagine a luxurious New York apartment divided into thousands of tokens. A Vietnamese individual could buy 0.1% ownership of that apartment for just a few $100s. This was a game previously exclusive to large investment funds or the ultra-wealthy. Now, it's becoming accessible to everyone. Tokenizing government bonds, private equity, and even works of art is diversifying the definition of investment assets more than ever before. Long-term growth and a maturing user base. Looking further out, the long-term growth data for this industry is truly cause for optimism. According to forecasts, the crypto market could reach over $13.6 billion by 2032, with a compound annual growth rate of 12.8%. Regardless of your skepticism, these figures confirm that the industry is still growing, and at a considerable pace. In an era where many tech sectors are stagnating, crypto's double-digit growth is a strong signal of its intrinsic potential. Another statistic that surprised me was that 28% of Americans currently own crypto in 2025, compared to 30% in 2023. Initially, I saw this as a decline, but upon deeper reflection, I view it as a result of a purification and maturation process within the user base. Previously, when the market was hot, everyone piled in without fully understanding what they were buying. Now, those who remain are generally more knowledgeable, experienced, and possess a clear strategy. A higher quality community will be a solid foundation for the market's long-term growth. So, what should we prepare for in the upcoming cycle? If you've been in this market long enough, you know crypto has never been a tranquil space. It's captivating and dynamic, but it comes with extremely high risks that not everyone is sober enough to accept. It's unlike traditional stock investing, where things move slowly and are somewhat predictable. Crypto is different. Its sensitivity to news keeps it constantly on edge. A single negative tweet from figures like Elon Musk, or a vague report from the SEC, can paint the entire market red. This creates a paradox: more and more people are entering, but most have an incredibly weak mindset. A small price dip is enough to send them into a panic, leading to sell-offs and even cutting losses at the bottom, inadvertently creating negative psychological spirals that drive prices even lower. This repeats in a cycle of collective psychology. Therefore, the first thing to prepare is a resilient mindset and a cool head to navigate all market fluctuations. Alongside that, legal regulations are a double-edged sword for this industry. On one hand, I fully support the need for crypto to be regulated to prevent abuse and foster a transparent development environment. But on the other, I clearly see many DeFi projects, especially younger ones, struggling under the weight of regulatory compliance. In the US, the SEC is expanding its oversight to all decentralized platforms, treating them as securities exchanges. This could significantly slow down innovation, as startups spend excessive time and money trying to circumvent laws or legalize their models. Many altcoins that thrived in a free environment now face the risk of being delisted from exchanges or losing liquidity due to non-compliance with new legal standards. I once followed a promising Layer 1 project that, due to its inability to standardize its token structure and cooperate with regulatory bodies, was practically pushed out of the game. It's a shame, as the technology wasn't bad, but in this market, good technology isn't enough. It must be accompanied by adaptability and survival in an increasingly scrutinized ecosystem. The growing threat of cybercrime. Another threat I see growing more serious is cybercrime. Ransomware, phishing, DeFi attacks, and rug pulls are severely tarnishing the industry's image. Every major hack, like the Ronin network incident or the recent Bitfinex hack, is clear evidence. After each such event, user trust erodes further. In reality, blockchain technology itself is inherently secure and transparent, but humans are the critical vulnerability in the system. When investors are lured by unreasonable profits, when development teams lack ethics, or simply when security is too weak, the consequence is always a chain of heavy losses that the entire market bears. The normalization of scams and market psychology. Even more dangerously, there's a normalization of fraudulent behavior. I've seen projects that were blatantly rug-pulled rebrand just weeks later and continue to seek funding. The community's short-term memory is strangely alarming. Some even admire scammers for their successful exits, viewing it as a joke, a zero-sum game, rather than a serious market. When I look at this phenomenon, I feel more worried than angry, because if even the community hasn't truly matured, how can we expect the market to develop sustainably? The core risk, investor mindset. Perhaps the greatest risk doesn't come from external factors but from within, from the participants themselves. The current market sentiment is extremely fragile. Everyone invests with the expectation of 2x or 5x returns in just a few weeks, so even a small correction is enough to cause panic. I've seen countless instances of FOMO at market peaks during bull seasons, and then those very same people FUD and sell at the bottom. The simple truth is, crypto is not for the impatient, just like anything else. But ironically, the majority of current investors are precisely that. This psychological loop creates a negative cycle: price drops lead to FUD, FUD leads to sell-offs, and sell-offs lead to deeper price drops. Only those with courage, a clear strategy, and who don't follow the crowd will survive and continue. The rest will largely serve as liquidity for the savvier players. All these factors, price volatility, risks, cybercrime, and market psychology, create an extremely harsh investment environment. This isn't a place for quick gains or seeking stability. Crypto is a place where you must learn to live with chaos, accept that you might be wrong, know when to wait, when to exit, and when to go all in. This has been a brief update on the crypto market in recent months. While challenging, opportunities are not scarce, and they only come to the truly wise. Do you think you're wiser than the rest of the crowd? Let me know in the comments below. If you don't want to miss out, follow my channel, turn on notifications, and share this video widely. Your support is the only reason we can research these explosive topics. I wish you all financial freedom soon.